and that researching obviously is a helpful step. You have to research, you have to know and be confident in what you're investing in, because that alleviates a lot of the fear that paralyzes us sometimes from making it a consistent effort to invest. So say, oh, I will try something because I'm not sure if it'll work, so I'm just going to try one thing and see what it does, instead of being in the mindset of making it a consistent habit. So when you think about that, it comes down to three things, which we'll go through tonight, which is researching stocks and understanding the potential, recession-proof stocks and what that means. Obviously, as they're talking more and more about a recession that might be on the way, which is normal, nothing to be afraid of. It's part of the cycle of our economy, of our society. Which is understanding how to position yourself and your money so that those recessions don't negatively affect you. And also just staying up to date with the news and understanding the news so that you know how it'll affect your money. So those are things we'll go over tonight, because all of those are parts of the process with research and finding companies. It's like, all right, now that we're in this time frame, I might want to look for recession-proof companies if I'm just starting to invest right now, and staying up to date with what's going on in the economy, in the news, even in the regular news, not even financial news, but the regular news that might affect things financially for you. So first things first, when you're looking for a company, some critical things to know is, how do I find these companies as far as information related to their stocks? Yeah, you can Google Amazon and it'll probably take you to the Amazon website. But how can I use, what information do I use to find information more about the stocks and the investment opportunities? And that's first and foremost being able to identify a stock ticker. So what is a stock ticker? It's just an abbreviation that the company has chosen, that obviously is available, no other company is using, that helps that company be identified on a stock exchange. So you'll see on this particular page, stock ticker and stock exchange. So most stock tickers, not all of them, but most of them that you will probably be looking into are 2 to 4 letters. Some of them are 1 letter, some of them are 5, but those are unique situations where companies have either 1 letter as a ticker or 5. We can talk a little bit about what causes that. But overall, when you look at a stock exchange and you say, all right, what is a stock exchange? It's basically just a market. So you have your New York Stock Exchange, you have NASDAQ, which are places where these securities, if you will, or these stocks are traded. So when you buy and sell using your brokerage account, your brokerage company has a representative at these stock exchanges that is inputting these orders around the clock, and it's done by computer, but they have somebody on site to kind of oversee to make sure everything is working correctly, because a lot of these things happen instantly via technology, and there's not somebody keying this in anymore as it was done in the past. But those are two foundational things and 2 important things to know about a little bit more about the technical side to stocks, as far as how you identify them with the stock ticker and essentially where they're traded, which is the New York Stock Exchange. When you say Wall Street, that's really synonymous with the New York Stock Exchange. The NASDAQ, which is also a trading market, is actually not even located in the financial district of New York. However, they both have similar properties as far as how they operate and the purpose of them. I'm not going to do a discussion before your own knowledge. People own or run management. No, that's a good question. I'm not 100% sure about that answer. I would say off the top of my head, no. But there are fees paid to those exchanges by the companies that are on them. But as far as the, I'm not sure what that monetization process looks like, but I definitely do know when these companies go public and are going to go on a particular exchange, they have to pay a fee to the New York Stock Exchange or to the NASDAQ to do so. But I'm not sure what those numbers look like and what the value of those agreements are. I'm just not sure about that. Ashley may know.
No, I just know that they pay a fee.
Okay.
It costs to be on a certain exchange. But that's all I know. I don't think they get like ownership in any of these companies.
Right.
But I think it does cost to be traded on the platform, and you have to abide by certain requirements to still be listed. So sometimes companies get kicked off of exchanges because maybe their price falls too low, various things financially. But I just know that you do have to pay a fee to be a publicly traded company, for sure.
So I think it's such a big discussion to talk about what to look for when you're looking for companies or looking for investment ideas. Um, and the philosophy that we always march with is first looking into the companies that you're familiar with. And whether you buy goods or services from them, and seeing if over time, based on what you know, and you don't have to be a complete financial guru to do an eye test to say, okay, this company is doing well, and they seem like they're going to be doing well in the foreseeable future based off of their gradual evolution as a company, what I'm experiencing as a consumer. Um, as far as determining if they have the potential to make you wealthy in the future if you owned a piece of one of these companies. So I always say that you need to look at the things in your life first that you buy on a regular basis, as far as the companies that provide those goods or services, as the very first options in which you want to invest in. Whereas some people often go wrong is they're looking for these quick hitters, these home runs as far as companies and investments that they're not even familiar with as a consumer or a user of whatever their company produces. And so it's rumors that that individuals are making decisions with. And then when it tanks or doesn't do as well, the person who just kind of chose to invest in it based off of the hype feels as though investing doesn't work or they're not good at it because they had a flawed approach to picking the companies that they were going to invest in. But then also, when you're looking for at companies in particular, have an idea of like who the CEO is or who led the company or who started the company, what's the overall value system that the company operates with, because that definitely contributes to the longevity and the success of the company. And also making sure those individuals haven't had any legal issues with either previous roles, previous CEO roles, previous investments that they've made as individuals, because the likelihood is that most people who choose to play or choose to break the rules are always going to try to find a way to break the rules in the future too. And lastly, and this is just a general note more than anything, is that investing is a long-term game. When you think about, oh, I want to flip this and flip that and penny stocks, whatever the other things may be, Forex, for instance, those are all short-term trading approaches. That is not investing. Like, there's a huge difference between investing and trading. And when you're thinking about your long-term financial success, it's more geared to investing rather than trading, especially if you don't have a lot of experience on the stock market so far. And making sure that you're making choices that, all right, I can see this company being around 10, 15, 20 years from now, not something that's like hot right now that doesn't seem like they have found a real way to be around 20 years, i.e., let's just say Uber or Lyft or these companies that are used a lot, but unless they find out how to make money, they're not going to be around 20 years in the red. That just doesn't work. That just doesn't happen. So, then somebody else is going to come along and innovate how to monetize a business like that and possibly replace them if they don't figure it out. But overall, my point is that investing is a long-term game. And to get in early and often is the way to win that game. There's no piece of information we have right now that will tell us exactly what the business world will look like 20 years from now. However, there are indicators that tell us, okay, this is the company that probably will be thriving 20 years from now, if they aren't already thriving right now. But Ashley, as far as what to look for, what would you say?
And for stocks,
Yeah, just as far as beginning to invest, look for companies, or just what to look for as you get into the game of investing.
I have a million things. The first thing you need to do, we actually have a slide on it, so I'll wait to do that. But the first thing you need to do, I would say the easiest thing is to do is to start with a company you know. Don't ask like someone you think is a stock guru what you should invest in. Literally start with a company you know and believe in. My recommendation would be to start with a large company, um, just to kind of get your feet wet. You want to make sure you know what the company does and you want to know what the company, how they make money. And the easiest place to get all the information you need, no matter where you go on Google, is the company's investor relations page. And so, for instance, like how you said, if you go to Amazon.com, you're not about to learn about Amazon stock. But if you go to Google and type in Amazon investor relations page, it takes you to the website that is specifically for investors. For instance, Facebook. Go to Facebook's investor relations. So literally investor relations. I'll type it in the chat. But that's one of the first places you need to start, because as an investor, that company houses everything you need to know about the company. It has all the company financials. It has all the company announcements. It tells you when their dividends are going to come out. It tells you when their earnings are going to come out. It tells you everything you need to know as a shareholder. And so that's the first place you always want to start before you go rummaging through websites. Let me type it in right now. And every investor relations page is different. So like for instance, if you guys are near a computer, I would definitely suggest you do this now. Go to Nike investor relations page. It's actually really cool. Facebook investor relations page is a really cool page as well. Home Depot. When I usually teach this class in person, we do it together. So you just literally want to go to Google and type in a company you're interested in and investor relations page and just browse through that, because you'll be able to see, is the company profitable? How much revenue did they generate last year? Who runs the company? You literally can see everything, because in all actuality, companies want you to invest in them because that's what drives their stock price up. So they're going to give you all the public information that you need as an investor. The other thing that I would say, I'm thinking about what we're going to be talking about. Like Rob said, you want to know the executives on the team, and the easiest way to think about it too is like if your homie was to start a clothing company, right? You need to know who's running this company with your homie. Do you believe in your homie? You know, like for instance, let's take Papa John's. The guy who was running Papa John's, who's also the founder, was racist. So you need to know who's dealing with the products and services that run the company that you're interested in investing in. If you don't believe, don't trust the CEO, that is the person that is going to be essentially running your business. So if your homie was asked you to be an investor in their company, you want to know everything. You want to know what products are you selling. You want to know, have you been making money? What is your marketing strategy? Who runs the company? You want to see the numbers, because in all actuality, you are putting your money up and now gaining ownership of a company. Regardless if you're buying 1 share, 2 shares, a half a share, a quarter of a share, you need to treat every investment as if it's yours. Like, this is my baby. This is my company. I need to know everything about this company, because how I perceive this company matters. My money matters to me. So it's great that you may love Amazon, but you need to know what the hell is going on with Amazon, because just at the drop of a dime, Amazon could do something you don't agree with, something that Wall Street doesn't agree with, something that the world doesn't agree with, and the stock drops. You have to be consciously aware of what's going on with all your companies from the start. So like Rob said, this is a long-term game. You're not invested in your homie's company to flip your money tomorrow. It's a company. So what we're talking about, like you said, we're not talking about trading. We're not talking. We'll work to get somebody in our community to help you guys if you are interested in trading. Rob used to trade. I did it for like a good 60 days and then it was too much for me. We're talking about the longevity of investing. We're talking about, yes, you have a job now, but in the next 10 to 20 to 30 years, you don't have to be at that job if you start little by little, brick by brick, layer by layer to start investing. So this, what we're describing is more of a long-term perspective, more of a researching perspective, more of an understanding perspective, and investing in companies that can turn you from a thousandaire to a millionaire to a billionaire, because that's where true wealth is built, by investing in someone else's idea or creating your own idea. So I would just say the first step, you want to make sure you go to a company's investor relations page, and make sure you know the details and the ins and outs of what that company does and how they make money. If I sit and sat here and asked you, this company you want to invest in, how do they make money? You know, did they make money last quarter? What are they talking about doing for the fourth quarter? You want to know, because as a publicly traded company, they have to release that information to you because they are no longer private. The world owns them. So they owe the world an explanation as to what's going on, what happened in the past, and what direction they're going as an institution.
Perfect. So when you're thinking about when you're in the process of finding just general information about companies, there are a couple things that you want to make a note of. And this is one of the ways that you can start to organize just general research and understand, okay, what's important to know right now, because there is a lot of minutia, there are a lot of numbers, there are a lot of ratios, there are a lot of stuff that companies track for purposes that might not be relevant to you as an individual investor, that sometimes is relevant to the large institutional investor that's putting in millions and millions of dollars at a time into a company versus someone who's starting small. So as far as organizing the information and knowing what's important early on when you're considering a company, it's broken down into, or at least on this page, into 3 different sections that we'll talk a little bit more about. But first and foremost, figuring out what industry is the company in and how are they evolving to stay competitive using technology and innovation. And one of the, as far as a scenario or an example that comes to mind when you're thinking about why this is important is, for instance, the industry of, let's just say the entertainment industry as a whole, but more I guess detailed wise, the video rental industry, right? Like they used to be a big thing. Like you had Hollywood Video, you had Blockbuster, you had a lot of these different companies, and they were successful. However, they were in an industry that technology and innovation would ultimately end and basically put an end to that entire industry. So it also is very important to know, okay, is the industry that this company that looks successful right now, is this industry an industry that could be really shaken up by the technology and the innovation that you are aware of at the moment? 2 is very important as well, is how does the company make money, and is their existing product or service actually profitable? I gave that example with Uber and Lyft, and there are a couple, I mean, there's a long list of companies that they raise a lot of money. And let me back up to explain how this happens, because I think you all would appreciate it. When companies are private, a lot of times they're using money that they have raised from private investors to operate. So let's just say when you might see on the news and might not known what it meant, but when you see something called Series A or Series B or Series C funding, it's like, okay, I don't know what that is. Basically, it's just waves of money that private investors have put into these companies. And usually to be a private investor for a lot of these companies, it takes large sums of money that the middle-class American doesn't have at their disposal. So it's almost a scenario where the rich get richer, because those are the first people who have the opportunity to invest in the private companies that might one day go public. And obviously their early investment, early on when they were still private, doubles, quadruples, even 10x once it goes public as far as the value of their investment. But nonetheless, a lot of companies are operating off of these lump sums that they've raised, and they're saying, oh, we got all this money to expand on our idea, and they're operating off of this lump sum that they raised. But as far as a month-to-month, day-to-day basis, they are spending more money than they're making. And then they get the idea to say, okay, we realize that our private investors' money that we raised is kind of running out. And instead of going back to them for more money, let's ask the general public for money. So we need to IPO and go public so that we can more so get a small amount from a lot of people rather than trying to get a large amount from a few people. And that's the mentality shift when companies go from private to public. So, but I guess the kicker in that is that companies like Uber, when they're private and have all this money raised, obviously their financial information is private and people don't know either how much money they're losing or just generally what the financials are. But we all think because Uber is heavily used that they're financially successful, which actually isn't the case as far as income versus expenses. So when you're looking at researching a company that's public, that's very important to know. All right, are they making money, or are they simply spending all this money that they've raised to this point? However, from month to month, their expenses are still more than their income. Because as you haven't looked at it recently, Uber has been struggling as a stock because of some of the issues they've had, not only from some of the operational issues with some of the culture, I would just say culture problems that they have, but also saying, all right, they're paying more money out the door than they're making from people using the ride sharing service. And it doesn't make sense to continuously invest in a company that is not profiting. So it's very important to know when you're doing general research, and how you know that is by keeping up to date with the quarterly earnings reports that they release. Every public company has to release a quarterly report that tells you what their revenue is, as far as, and when their revenue, that's just all the money that came in. And then earnings is more so related to profit. And there's a couple other factors in there that make it a difference, and we won't go too far into the weeds with that, but essentially revenue and earnings are published for every public company every quarter. And that's where you can see, all right, is this company profitable? Where are they trending? Are they getting better? Are they getting worse? And then lastly, one of the other last things that you can do as far as general research, which we've already kind of touched on, we will touch on again tonight, is just how to look at a stock chart and what numbers are important on a stock chart. And either using a spreadsheet to track that and say, all right, this is a company I'm interested in, let me put it on a spreadsheet. I use spreadsheets. I do have a watch list, but I also track every company I've invested in or want to invest in on a spreadsheet. And I guess I'm just technical in that way, but either way, that's how you want to track the companies that you're interested in or the company that you're invested in. Keeping them on a spreadsheet or keeping them on your watch list, either on a StockTwits app or on your brokerage account. Every brokerage account has a watch list as well. Did I miss Kevin? Kevin's talking about Nike. Okay. I don't think I missed any comments. Cool. Any other, I guess, general research pointers you would give Ashley on how to organize information, or just what to look for first?
No, this is fine.
Okay. So, thinking about, all right, if you were to get on your phone right now and say, all right, I want to find if this company that I think is a very good company or up and coming company, that's hard to say, um, is available for me to invest in. One of the easiest ways to do that is to Google the company's name and also with the word ticker, because that's going to immediately bring up the stock ticker if it exists, which automatically tells you if it's a publicly traded company. And usually in those search results, if you were to search that on Google, it'll bring up links to either Yahoo Finance, CNBC, Bloomberg, a couple other websites. If that company has a ticker sign, and it'll obviously the results will tell you what that ticker is as well. If not, your results will be a lot less detailed. It'll probably say that this company doesn't have a ticker or doesn't exist or can't find, which means that the company is probably still private, a privately held company, meaning that they only have private investors, not public investors. If the company is public, as I was saying, in those search results, there probably will also be a stock chart that Google provides that you'll see, and we've looked at it before. But that stock chart, and you'll see the price on there, and the graph, you'll obviously know as well that the company is publicly traded, and you can review that chart for key details that'll tell you about the basics of the stock. And in addition, under that chart, when you keep scrolling down in the Google results, you'll see links to press releases, articles, other things that may be relevant. And even if you don't feel like you'll know what they're talking about if you read the articles, it's always important to just expose yourself to something new and say, all right, I might not know exactly what they're talking about, but let me read this so I can start to get more acclimated to the terminology that they use. So then when I come into the community and on the timeline, I saw something and I don't know what it means, you can ask not only Ashley and I, but other people in the community that might be more familiar, as to say, hey, I saw this article that said this. What does that mean? And in our community, it's created to make sure that it was a judgment-free zone, that you could ask those questions and not feel like it's a stupid question, not feel like it's a question that's kind of out of place. So I always, always, always recommend that if there's a company that you're interested in and you know it's a publicly traded company, read a couple of the recent press releases and articles just to see what the current news is with the company, as far as the news that might be financially related. Because the news you'll hear on CNN might be completely different from the news that you hear on Yahoo Finance or on CNBC. Even though things might be happening at the same time. For instance, with Facebook, they were on CNN a lot when Mark Zuckerberg was going into those hearings, talking about the privacy of the information, and they were more so talking about the semantics around things around privacy. And then it was somewhat related, but then the articles on CNBC and Yahoo Finance were more so talking about how those general news stories were now affecting the stock prices and people's willingness to invest in Facebook or any of the companies associated with Facebook. So there's always kind of two different stories. When you hear the news, you'll hear the general news as far as what the general news station will cover, which might not be financially based. And then you also get the version of that news in a financial perspective on some of the financial news outlets. And once you start reading those articles in the financial news outlets for some of the general stories that might be easier to grasp and understand as far as general news, you'll start to see the connection between, all right, this type of news, general news, affects stock prices like this in general and vice versa. Oh, when the earnings come out for a particular company and they're good, then sometimes that news makes its way to general news as well. So it goes both ways, but it's very important to make a habit of looking into some of those things as far as just research basics. Any questions thus far around just some of the things that we're touching on right now before we start to go into more details? Because this is all kind of 30,000 foot stuff. high level general things. But are there any general questions about things we touched on thus far before we move forward? Let us know. Say yes or no in the chat, and that will be helpful to let us know whether or not we need to move on or not. Okay, so we got to know. Anybody else need something explained or any extra detail to something on the last couple of slides? If not, we'll start to go into more into detail. All right, cool. So here I thought of a couple questions. And these are all questions that I look for the answers. Some of these are kind of redundant based on the last pages, but some of them are new. And these are the questions that I always ask myself and I always look for if there's a new company that I'm looking to invest in. So for instance, the last company that I really did research on was probably Popeyes, which is actually owned by Restaurant Brands International. It's the parent company that also owns Burger King. And when I looked into, and this was obviously around the chicken sandwich craze, and so when I researched the actual company, and not just making a decision based off the fact they're selling all these chicken sandwiches right now, because that in itself is more of a trading mentality than an investment mentality, simply because these chicken sandwiches is a short-term influx in their business. That chicken sandwich probably isn't a long-term solution for what's going to keep that company successful for the next 20 years. So when I started to look at the research, I said, all right, what's the recent news outside of the chicken sandwich? Is there any recent news for this company? And again, it's not just the Popeyes company, but just the overall company that owns Burger King and Popeyes and a couple other smaller chains. And one of the big stories for them was they were looking for new products to introduce so they could rebrand themselves, which makes sense because for Popeyes, they introduced this new chicken sandwich. For Burger King, they introduced the Impossible Burger, the vegan alternative to the Whopper. So as a company, recently, they've been focusing on new products to build or to evolve their brand around. So that was some recent news that I found when I just generally researched. Again, for this particular company, how they make money, they sell food. That was a pretty easy one. And again, products and services, the selling of food, fast food. And then I looked at, one of the things that I looked at also is how the stock's price has changed over the last 5 years. I'm sure a lot of you all have been on in a couple of the earlier sessions, but when you look at a stock chart, it's nice your first time tuning into the boot camp. Look at a stock chart. The last 5 years is a great window to look at as far as performance, because last year it could be misleading, especially anything less than a year. But once you start to look at the 3-year or 5-year, or in some cases the max chart, as far as however long the company has been publicly traded, and you look at how that graph is trending, it tells you a lot. And it tells you a lot because you can see the direction of the confidence of the company and also the value of the company based on that stock chart. So if you looked at the stock chart for Restaurant Brands International, which is the owner of Popeyes and Burger King, you'll see that over the last year or so, they've really done well as a company. And that's partially because they bought into companies like Popeyes, or either increased their ownership stake in a company like Popeyes or Burger King. And also, lastly, did they meet expectations during the last earnings report? I don't just look at the last one, I actually look at the last two. Because sometimes companies are seasonally exceed expectations. Like for instance, Amazon and Target and Walmart always do well in Q4 because of holiday season. And Booking International, which is a company that owns Priceline.com and a lot of travel sites, they always do well in the spring when people start to travel again. So you want to look at more than one quarter, just so you're not looking at an outlier as far as a quarter's performance. And you can easily find that on Yahoo Finance or CNBC as far as what their last 2 or 3 quarterly reports are. And it's not necessarily about knowing what those numbers mean. What you're looking for is if they beat expectations or not. And that's something that's clearly shared when you look at these reports. They'll show expectation versus result as far as, okay, they were expecting to earn 7 billion and they earned 7.1. They beat expectations in that particular example. So you're looking, the number itself isn't as important as whether or not they fell short or exceeded what they were expected to do. So if you're not the numbers person or don't know exactly what all these numbers mean, that's okay. What you're looking at is based on whatever the projection was, did they do better or worse? That's what's really important. Ashley, you have anything to add?
No, I would just say that expectations are really important because Wall Street analysts spend a lot of time working directly with the companies to be able to estimate what they're supposed to do financially that quarter. So there are people who are trained and paid to analyze these companies to project what the company should do. So it's really big if companies don't hit analyst expectations, that means that there's something wrong, or that's how it's perceived. So that's why something like that is important, because what analysts project is closely aligned with studying the ins and outs of that company and working closely with that company to determine what they should be doing as an institution.
All right. So again, I just brought this up. Just we've looked at this before, so don't think you're going crazy. Like, oh, I think I've seen that before. You have. But I wanted to bring back up this slide, being that we're now talking about finding the company and the first things you'll see possibly in your search results. And again, this is a stock chart. You'll see that it's set to show you the last 5 years. And then as far as the information that you're organizing, again, you're looking at some of these key numbers that are very useful, which is understanding, okay, what's the health, if you will, of the company right now, as far as how much is the company worth as a whole, which is always cool to know. But also, does the company pay a dividend, which it'll tell you in that dividend yield box. If it's blank, there's a line there, they don't. But if there's a percentage there, then you know they do pay a dividend, which is basically ultimately going to be a form of income for you when you own the stock and you're just taking the dividend checks after accumulating shares over the course of time. And then something that more so tells you about the trend of the price of the stock is just looking at the 52-week high and 52-week low and seeing what the current price is compared to those two numbers as far as the high stock price and the lowest stock price over the last year. Again, and this is also a review type slide, that private companies, we can't invest in them yet. Usually in order to invest in a private company, you're usually friends or family, and it takes a large check to get invested. But public companies, as we have already talked about, are available to invest in on the stock market. So one of the things to look at if you are interested in a private company, as Ashley said, looking at their investor relations page on their website, which might give you some intel on if you could possibly become a private investor before that company goes public. I've done that in one instance in my entire life, as far as privately investing in a company that was a very large company that wasn't on the stock market, and which it was a good experience, and like it did well, but at the same time, it was a scenario where I was right place, right time, as far as being connected with the CEO and the founders of the company, and had that opportunity to do that. But if I wasn't right place, right time, I wouldn't have even got that opportunity to invest privately in the company. That's pretty formidable. That's considering going public versus public companies that, all right, the stock price and the share price is probably less than $500 for most companies. Private companies, you might need a couple thousand just to get in the door. So I think this is cool. This is kind of the second section of tonight, talking about recession-proof stock ideas and companies. And the reason we wanted to talk about this tonight, because of the looming rumors or just banter around the fact there might be a recession on the way in the next 12 to 18 months. And the reason that's been talked about so much is because there's this chart it's famously called the yield curve, but it's a longer technical name to it. But basically this chart has historically predicted every single recession in America's history. And over the last probably about a month ago at this point, the yield curve inverted, which is just basically these two lines are on this curve switch spots. And whenever that happens, 12 to 24 months later, a major recession starts. So the fact that happened, it literally happened twice in 1 week about a month ago, and they got everybody talking and say, okay, here it comes. And it's basically right on time. It's been about 10 years since our last recession. And these recessions happen every 10 years. It's a cycle based on how our financial system is created, that they have to happen, because if they don't happen, then our country will cease to exist if these recessions don't happen. There's a long explanation behind that I won't get into. But nonetheless, recessions have to happen or our financial system will crash. Which sounds crazy. It's like, why does a recession have to happen for the system not to crash when it seems as though a recession causes a crash itself? It's convoluted, but it's the reality. So as you want to explain kind of what your thought process is around considering or thinking about companies that possibly might be recession proof?
The first thing you want to think about is, one, when everybody's angry and scared, you are the opposite. And so you want to think about who is thriving during a recession, right? So Rob, you know the answer to that question?
Say that one more time.
You know the answer to that question that Kevin just asked?
Oh, I didn't see the question. Hold on. Does the system also predict? Or does it not really matter? Oh. Well, I think the shortest way to answer that question is a recession will last as long as the Federal Reserve lets it. Which means that whenever a recession happens, the fix for that in American society is to lower the federal interest rates. Because that's the only thing that gets money moving again. And it's basically the Federal Reserve plays chicken with society to say, okay, we're gonna wait until let's see if the market corrects itself. But if it doesn't and it keeps going on and on and on, before people get too afraid that at the end of days, we'll lower the interest rate to get people borrowing money again, because borrowing money is what keeps our system going. Debt is the foundation to our financial system. So how long basically depends on how conservative or aggressive the Fed chair is, which right now is Jerome Powell. Before it was Janet Yellen. Before that it was Alan Greenspan. So Alan Greenspan was was known to be very well. He kind of switched sides between being aggressive and conservative, and that was in the Clinton days. And then during the Bush presidency is when it switched to Janet Yellen, who she was pretty good. She was actually really good. And then now it's Jerome Powell, which has kind of been the Trump era of the Federal Reserve. And so they have the power to decide really how long a recession lasts if one happens on their watch. But when you're talking about investing long term, a recession is actually the prime opportunity to invest because everything's cheap. And you know that even temporarily everything is low, but it's going to go back up. That's the whole buy low, sell high. Buy low is when you buy during the recession. And then later down the line, if you want to, you sell those stocks after the prices have risen once the economy comes out of a recession. That's the wealthy game that's played every single cycle, which is why we're talking about tonight as far as investing in these recession-proof companies, because you want to start to play the wealth cycle, not the poor cycle of the money game. So hopefully that answers the question, Kevin, and is as clear as I can possibly make it in 3 minutes.
All right, back to this. So the easiest way to figure out where to invest and what to invest in the stock market during a recession is one, to figure out who is making money during a recession, right? So think about what goes bad during a recession. People lose jobs. People lose jobs, they don't have enough money, right? So they're not spending as much money. Versus if everybody has a job and money is just flowing, people are able to spend more money. When people are able to spend more money, companies make more money. It's the complete opposite during a recession. So money slows up. People are losing their jobs, which means they aren't able to buy more. And if they're not able to buy more, that means companies are making less money, which is why the stock market drops, because if numbers aren't hit, then companies are losing money. When companies lose money, investors get scared, and so they sell, right? You have to think about, okay, even though people are losing money or aren't spending as much money, that doesn't mean the circulation of money stops. People are always spending money, just not as frequent, right? So when you think about if you were to lose your job right now, or your business, whatever, money was to just stop right now, right? What are the things that you have to pay for in order to survive? So for example, you have to eat, right? Now that doesn't mean you're going to Ruth Chris because you don't have money, but you still have to eat. So if people still have to eat, they're spending less money. So who sells food that is cheap? So for example, you may not go to Whole Foods, you might go to Costco. That's why Costco is on the screen. We're not necessarily saying invest in these companies, but if you Google these companies during the recession, look at their stock prices during the recession, 2008, 2009, you will see that there wasn't a drastic drop. In fact, they slowly progressed because Costco was making money while everyone was losing money because people wanted things cheaper. We don't usually go to Costco when money's just flowing because it's not as conveniently it's not convenient. It's not, you don't find Costco, you don't have as many Costco's as there are Targets, right? Another thing too is like we may need some clothes. We may need toiletries. Where do we go buy those things, right? You probably will go to Walmart before you go to a Target. You probably will, but you still need to buy soap. So who's making soap? Who's making toothpaste? Those things will still regularly be bought, right? You're like, reason we have McDonald's on there is because, again, you might not be eating fancy foods, but you still have to eat. So you have to start to think about, if I was a consumer and I need to survive during a recession, what must I pay for? As opposed to going to a fancy Target, I need to go to the dollar store to get stuff that's cheaper. There are companies that thrive during a recession. Whenever there's a loser, there is always a winner, and vice versa. So when you start to think about these companies that you want to invest in, and these companies that you want to be able to still, companies you want to invest in that will allow your money to still grow, you want to think about who is still going to make money and thrive in America as a result of recession. The other thing you can think about too is what companies have survived a recession. What companies have been around for hundreds of years 50 plus years because they've lived through certain recessions and they're still standing strong. So what companies are strong enough to survive a recession that can still come out strong after a recession? And if you're not 60 years old, you need to start to think about how can I monetize off of getting these stocks cheaper so that as a result of the recession, these companies continue to grow. Like Disney's been around for 90 plus years. Disney has lived through recessions. You get what I'm saying? So, and Disney's still paying a dividend. I would also consider looking at different dividend paying investments because dividends are just extra cash flow that is paid out to all shareholders after companies have paid off all their expenses. Profits are distributed to shareholders. Meaning, if a company can pay you a dividend every quarter, that means that they are profitable every quarter. So if what companies were paying dividends during a recession, which means that they were profitable during a recession, right? So at least you can still get paid dividends. At least this company is still standing strong and has the ability to stand strong after the recession is over. We get so caught up in what's going on during a recession that we don't think about what will my money be like after it's over. What if I actually get through it? Like it's kind of like for the ladies in here, if you go through a breakup, like I'm sure you've been through a breakup and it was hell when you went through it, but you came out so much clearer after the breakup occurred, right? So it may not have been as bad as you thought it was because you needed to become a stronger woman. So you got to think about what is life like after the rough times? What is my money like after the rough times? And that's how you start to think as an investor. Because thinking not like an investor is like, oh my God, I'm freaking out. Let me sell all my stuff. I'm losing money, because that is what the media is supposed to do to you. And if the media does that to you, that means the media works, right? That means the media is making money off of you. Let's see, I have a question.
So hold on, time out. Why can't guys get better after a relationship?
I mean, I just don't see guys crying and boo-hooing like a woman does. So
okay, all right.
I mean, I'm sure you can, but was your relationship a rough time and y'all just broke up and times were just rough? Like, I think women are a little bit more emotional, shed some more tears than emotionless men who act like they're emotionless. So in all actuality, if you went through a breakup and it was rough and you cried and your heart was broken, like outside of that broken heart came something beautiful. So that's all I'm saying. Now, okay, you want to talk about your breakup, Rob? What breakup did you go through, Rob, that you got through?
No, I mean,
came out strong.
I just was poking fun at you, but I think men, we might not be outwardly emotional, but we have the same feelings that anybody else feels. So it's just that we might not apparently display them, but we feel the same feelings. But anyway.
All right, let me go back to these questions. So I'm gonna go in order. Should we also look at companies that have a global footprint during a recession? So they have money coming in from different countries if a recession is happening. Yes. However, if America is suffering from a recession, it has a direct impact on the world, without a doubt. So I think it's good to have diversification, that the products are international products and services, but just because companies are struggling or not as profitable in America doesn't mean that it's the same in other countries. But if America is struggling, other companies can feel the effects of our pain because we do business in other countries. So it is a plus if your company is an international brand because that means that revenue is coming from multiple places, without a doubt. And just because one area is lacking, that doesn't mean the other areas aren't thriving. But that doesn't always mean it works out perfectly. Like, oh, America's down, but China is up. And more of Apple's products are sold in China than America. Like, regardless, it still affects the stock price, especially if numbers aren't hit the way we projected it to be. But you also have to understand people are just scared. Like, I'm afraid everyone's going to be afraid too. And if everyone's afraid too, and I'm kind of afraid and everybody's going to sell, and if they sell, then my stock price is going to drop, even though I'm not kind of scared, but I'm tired of seeing it drop. So maybe I should just get out of here and capture the gains that I made, right? Those are the thoughts that go through people's mind because that's all you see and that's all everybody is talking about. Like, for example, just take like American racism right now. Like, not saying that racism didn't exist, but it wasn't as in your face where fourth graders are talking about racism in America and they're consciously aware of it, right? it is just the thing to talk about. Being woke is the thing to talk about. Beyonce doing an HBCU performance at Coachella is in right now. Being woke is in right now. So that's what everyone is talking about, and that's what everyone can also monetize off of, both black and brown and white and purple and Asian companies, because right now the suffering of African Americans is blatantly evident in America. I don't care what nationality you are. We have a president that has amplified racism. So now there are people who are taking advantage and monetizing off of the struggles that black people in America are going through, right? And just because they're monetizing off of it doesn't mean that that's a bad thing. I'll give you an example. I was just on the phone with the bank today, and their core focus is to show, hey, we're not just trying to sell you products. We want to help you. We want to build you. We care. Or, hey, we want to do this for black people. Because if they don't show love to black people won't consume, right? So you want to make sure that what is going on, and because it's popular and it's popping and everyone's talking about it, it creates some momentum. Take the Popeyes thing. Everybody was talking about Popeyes. It's what was going on, and it was causing everyone to act based off of the momentum. That's all a recession does, and it just causes people to sell, because people are trying to make as much money as they can, and if they feel the price is dropping frequently, that kind of frightens people. It frightens institutions because they don't want to lose out on the money that they gain, and they don't want to continue to see losses, because these banks and institutions survive off of their investment accounts. The same way we're investing, companies are investing too, for their own personal reasons, right? So I hope I answered your question. So there's really no right or no wrong. You just want to know if your company, how much of your company's revenue is coming from America. How much of your company's revenue is coming from Europe. All those things you want to take into consideration. In 2008, Citibank went down to $1, $3, and I didn't buy. I'm sick about that now. Yeah. Not everybody makes it through recession, but I can tell you one thing. America will let a weed company or a consumer company fall before they let a bank in the United States fall. So, yeah, I mean, those, what'd you say?
No, go ahead.
Those prices freak people out. I got in Bank of America really cheap because I saw Warren Buffett racked up. Again, you have to think about what you're thinking about and think about where these thoughts are coming from. Are these thoughts coming from the research that you've done and the feelings that you have, or have they been inflicted by the feelings and thoughts of other people, of the news, of America, right? It's like, are you buying the Popeye sandwich because you really have been eating Popeyes all your life and you like their food? Or are you buying it because everybody was hype about it? That's the power of marketing. And that's what I feel like the news does. They trigger emotions to cause actions that lead to a certain result. And that's what a recession does.
If you all are into movies at all, Jamel, watch Too Big to Fail. It is a wonderful movie about just what happened in 2008, but it'll give you great insight on possibly what's about to happen all over again. With this recession, as far as just the financial companies and financial institutions, I know it's on Netflix, and it's an original HBO movie, so I'm not sure if it's on the HBO. If you stream HBO, if you have HBO as a channel, but that's a great movie to watch to understand. Not only, it's not going to talk a lot about investing, but just to understand what to expect whenever there is a financial crisis. It's a great movie to watch. But Shanitra, your question. So when there is a recession, even if the company is not profitable, they could continue to pay their dividend. It's not a direct correlation. Most companies are in a financial position that if they are paying a dividend, they could do so for a couple quarters, even if they aren't profitable, until they start to run out of assets, and they might have to ultimately change that. But usually, companies do not want to discontinue a dividend because it scares their other investors. And it's like, oh, they stopped their dividend. Are they about to go out of business? Are they about to get bought out? What's going on? it ruffles a lot of feathers. So they try as hard as possible to not discontinue a dividend if they're already paying one. And in the case that they do, I think the best example is actually stated is GameStop, in which they went through about 3 or 4 bad quarters of earnings until back in June, they discontinued their dividend after about a year of poor performance. Because they were trying to figure out how they're going to survive as a business now that people are downloading video games straight to your system via the internet and not going in the store and buying a physical copy. So that's one example of most recent example of a company that was paying a dividend even though they were losing money, but it eventually stopped. Do dividend percentages rise and drop, or they pretty much? They do rise and decrease, not tremendously. Again, they don't want to scare their existing investors by dropping it too much, but at the same time, they don't necessarily increase it too much because there might not be a large benefit for choosing to pay out a bigger dividend if you're already attracting vet investors with your current dividend, which you think about a dividend and why companies offer it in the first place is one, to attract more investors, and two, to keep the current investors. Because as a company, if you didn't have to, you wouldn't pay out the profits if you didn't have to. But they've chosen to do that to continuously raise more money from the public, so that instead of going to a bank and saying, "Hey, bank, I need a loan, a business loan," that they know they're obligated to pay back, they can go get investors and get the same amount of money from investors and not necessarily have an obligation to pay you back, even though they have an interest to pay you back. It's not an obligation like a loan. And so they would much rather go get more investors than go get debt. And in order to attract more investors, companies choose to pay a dividend. Did that answer the question? Okay, cool. And then it was one other point I was going to make. So as far as we talked about companies that could do well in a recession, but when you think about the companies that don't do so well, you think about construction companies, and I'll explain these. But construction companies, high-end retail, that's kind of obvious, and also travel, that's kind of obvious too. But for the construction part, that's important to know because our society is one of the driving factors in our society is real estate. However, if there's a recession, which probably means that people are borrowing less money, i.e. a mortgage, that less homes are being built, and it's kind of like a domino effect, because when less homes are being purchased and less homes are being built, then it affects the Home Depots and Lowe's of the world that might sell home improvement goods. And so there's a domino effect in certain industries when Americans stop doing what Americans do, which is borrow money and buy houses. And when that slows up based off of a recession, it affects so many other things down the line. So you want to think about that when you're thinking about recession proof. Like, for instance, Home Depot is not recession proof. Whenever there's a recession, Home Depot sells tremendously slow. However, they might continue to pay their dividend because they know it's a cycle, but their stock price almost always decreases in a recession. But again, that's an opportunity more so than something to be afraid of, because I don't see anybody outside of Lowe's and Home Depot coming up as a home improvement supplier. So when the recession's over, they're still going to be there making money. So you might as well buy a piece when it's really cheap. Any other questions or just general things you want to share to get either Ashley or I's feedback on? around not even just a recession, but just in general with looking for and finding certain companies? I'm gonna take that as a no. Okay. So, thinking about where. Okay, where do I get information from? As you can see on your screen, these are some of the most credible news outlets that you would want to be checking for news articles, general stock price information, also just general economic information about recessions and things like that. These are some great websites to familiarize yourself with. I personally, I'm a fan of CNBC and Yahoo Finance. I more so watch Bloomberg on TV, but that's just me being a nerd. I don't really go to Bloomberg's website a lot, but CNBC and Yahoo Finance are great, and even CNBC in particular, they have a great notification system so that if you're not always in the mood to go look for this information, you can download the app and just get the push notifications on like relevant or major news issues so that okay, I'm not going to go look for this every day, which like is not really normal and natural for a lot of people. That's okay. But when major things do happen, I can be aware of it by making sure I get a notification, which I think is a great way to take a step in the direction of being more financially informed. Google, I'm trying to see if there's anything else I was going to say about this particular slide. There are a couple that aren't on here. You have, for instance, there's a website called Motley Fool, Wall Street Journal. And the reason I didn't include that on here was because Wall Street Journal is an amazing, probably the best. However, you have to pay. So all of these ones I listed are free. Wall Street Journal is a subscription, but they have a lot of information, probably more than a lot of people care to know. But those people that might have a financial background, I'm sure you're pretty used to looking at Wall Street Journal. But for everyday person, these on the screen are perfectly enough. And there's not a lot of minutia or just random information on these sites like it is a Wall Street Journal. So I would suggest to download one of these apps. Either out of all of them, I would suggest CNBC and download the app on your phone. If not CNBC, possibly Yahoo Finance. Both of those are really great and a way to stay on top of, all right, when the Fed cuts interest rates. And while we're at, and let me actually stop for a second and talk about this because even though it's not necessarily relevant to researching and finding stocks, I think it's very important to understand why that information is important. As far as when you hear the Fed cut interest rates, first of all, what does that mean? Not only for my life, but what does that mean for investing? Everything. So the broad, I guess, description of this process of the Fed cutting interest rates. In the Federal Reserve, first and foremost, every bank in America borrows money from the Federal Reserve in order to operate. That is the way it goes. A lot of people think these banks have all of this money. No, banks are essentially, in a lot of cases, cash poor as organizations because there's so much money going in and going out as far as loans, but also a lot of money going in as far as deposits and whatever the case may be. However, when they realize, hey, in order for us to continue to loan more money, we have to borrow money, they go call the Federal Reserve to borrow money. And when they borrow that money, the interest rates that you hear about when the Federal Reserve cuts the rates, those are the interest rates that these banks are paying for the money. So we're talking about billions and billions of dollars And right now, the federal interest rate is 1.75%. And that's literally bank to bank transactions. But then you have to ask yourself, okay, why is this important to me as an individual consumer? It's important to you because those interest rates ultimately trickle down to the interest rates that you pay on the money that you borrow from a Bank of America or Wells Fargo or SunTrust or PNC or Regions or whatever the bank is. So when the Fed interest rate lowers, is in all likelihood, mortgage rates are going to drop, car loan interest rates are going to drop, and when the Fed drops interest rates, it's usually a sign, or it usually influences the general public to say, oh, I can afford that mortgage at this interest rate. Let me go buy a house right now. Because the average consumer is looking at the payment, not thinking about, all right, it's like I can afford $1,000 a month. Let me go buy a house. But they're not necessarily thinking that about how that interest rate for the mortgage really factors into the affordability of the house. And so when the interest rates are going down, that's a sign that of two things. Either the Federal Reserve is worried that the economy might start to slow down and they try to get ahead of it and say, let's lower the interest rates now to keep this thing going. Or it's a scenario where everything's already dropping, the recession's in place, and they have to lower them to get people to borrow money again. So one of the things, during Obama's whole tenure, his entire tenure, they dropped the federal interest rate to zero. The Federal Reserve was giving out money for free to banks, which enabled people to borrow, buy homes, and do all these things that they've done since 2008 to get the economy going again. But when that happens, that means more money is in circulation, and usually when the federal interest rates drop, the stock market does well. And when the federal interest rates go up, the stock market does bad. That's just generally how it works. So if you're thinking about, hold on, that's very interesting that under Obama we never had a rate cut because just yesterday now. Oh, no, there was. So when Obama got in office, they made the interest rate zero. It was like 2 point something.
But don't forget, he came in the midst of a recession.
Correct.
He came into a bad country. Trump came into a good country that is slowly now going bad. But we talking about 10 years of a difference now from when Obama first got elected till now.
So when Obama got into office, everything was already in disarray. Everything was jacked. And a part of this bailout that he signed off on for these banks, a part of that bailout was allowing them to borrow money from the Federal Reserve at 0% interest. That was a part of the bailout. So not only did they let them off the hook for certain things because they just couldn't allow these banks to fail, because if the banks failed, who knows what had happened to America. But that was what happened. And then for the next 8 years, all of the consumer banks, the Bank of Americas of the world, Wells Fargo's of the world, could call the Federal Reserve and say, hey, I need $20 billion because we got all these loans that we just about to give out. We need $20 billion right now. And they're sending over $20 billion and not charging any interest on it. So then fast forward to now. And towards the end of Obama's tenure and then starting in Trump's tenure, the Federal Reserve is like, hold on. We've given y'all 8 years of a discount. We need to start making money again because the national debt is continuing to climb. Because when you borrow all this money from the Federal Reserve, it's just more money that the country owes to the Federal Reserve. Because the Federal Reserve is a private bank. The Federal Reserve is not the government. People just think that because it's called federal. The Federal Reserve is a private bank. So you think about, they would let people off the hook, and because they wanted to cooperate with the government, because if everybody loses, everybody loses. So they didn't want everybody to lose, so they cooperated for 8 years, and then they said, hell, we can't do this anymore. We're gonna have to start charging you all for this. When I say you all, these banks, for this money, we're gonna raise these interest rates. And that's basically what happened at the beginning of Trump's tenure. And he's been, so Trump has been continuously attacking Jerome Powell, who's the Fed chair, because he's mad at the fact that the interest rates are being raised during his presidency, which will likely cause a recession. And that's his stance. Now, is that true? Not entirely. And so recently, because of the inverted yield curve that I talked to you all about earlier tonight, as far as the fact that these two important lines on this particular chart flipped about 2 months ago, it kind of scared the Federal Reserve and say, hey, we might have gone about this too quickly as far as raising these interest rates. Let's scale it back a little bit, because we don't want to cause another 2008 if we don't have to. So that's why, even though these rates have gradually been going up over the last 2 or 3 years, I guess yesterday or 2 days ago, they decided, hey, let's scale it back down a little bit, because we noticed that we were kind of in no man's land for a quick second. So that's basically what's happening right now. But again, it's important to understand. You don't have to know all this stuff technically, but it's important to understand just when this goes up, what goes down, and when this goes down, what goes up, just so that you're aware of and more confident in what may be going on with the money that you either have invested or the money that you want to invest. So, again, on CNBC, if you download the app and turn your news notifications on, you'll get an alert when large decisions like this are made, and you'll just have an idea. It's like, oh, okay, I kind of know what this means. Outside of the numbers and the rates themselves, I just know, okay, the rates went down. Okay, I know what that's probably going to cause generally in the stock market. So that's why it's so important to try to stay on top of these different news events, because they do ultimately affect your money, not necessarily immediately, but ultimately the effects will be felt by you, because we're all operating and living in the same economy. I know I said a whole lot just now, but was that pretty clear to everybody as far as how that works? All right. Okay, cool. So next time you see federal interest rates go up or down, you just know they're going down. Stock market's probably going to do well in the near future, and it might be a good time if you're going to get some type of debt, car, house, or something. When the interest rates are going down, might be the good time. When they're going up, you got to kind of see what the heck is going on, because when they go up, certain things may be affected by that. Credit card interest rates go up, all types of stuff. And I know you all might have heard of an adjustable rate mortgage, or your credit card might have an adjustable interest rate, meaning that when those interest rates change, your interest rates are going to change in the near future, instead of possibly having a fixed rate mortgage or a credit card that has a fixed interest rate. Those federal interest rates, those Federal Reserve interest rates, directly affect adjustable rate debt, whatever it may be. And that's just something just generally to understand. The numbers themselves, they're always different, but conceptually, that's what's happening. So hold on, let me see here. So lastly, we're on this last slide. Got a couple different exercises, and today our takeaways are going to require some action from you, because investing is a process of taking action. And one of the very first things you want to do is list out 20 companies that you regularly spend money with. You might think, I can't think of 20. I'm sure there's 20. It's probably closer to 30 or 40 if you really sat and thought about it. And in order to do that, well, first and foremost, I would suggest you all to take a screenshot if you're on whatever device you're on, of these takeaways, just so you can have a reminder. But look around your home: cleaning products, groceries you regularly buy, appliances. When I say appliances, that includes TVs. I know you're not buying a refrigerator every day, at least hope not. But when you buy TVs, do you buy a certain brand? But smaller appliances too, a blender, toaster, certain things that you might buy, especially when you move. And if there's a certain brand that you like, think about that company. Clothes, toys, hygiene products. I personally invest in Procter and Gamble. Procter and Gamble not only pays a dividend, but no matter what goes on in the economy, people are going to buy cleaning products and hygiene products that Procter and Gamble makes. Period. So I know no matter what, Procter and Gamble is going to do well. That's just an example though. You have companies like Unilever that make soaps and other things that we all regularly use. But just look at what you buy and look in your house and turn that thing over and see, okay, what company made this? Because I'm always buying this. And list out 20 companies that you regularly spend money with. And we're going to have an exercise that follows this up. But in order for you to get the most out of this boot camp, please take the time to do that. It's like literally can be a 10-minute thing. You can do it with your kids and to tell them, go find your favorite toy and bring it to me and turn it over and see what company made it. And just make sure that you are becoming more aware of the companies that are regularly getting your money, because those are some of the first companies you want to consider investing in. Number 2, creating a watch list. And a watch list is basically just a list that organizes information about stocks for you to view very easily and quickly without having to go look for it. And you can have your watch list on StockTwits, the app in which we use for our community, or if in your brokerage account, or even in your individual, if you have an IRA, an individual retirement account, you can add companies to your watch list. So to say, all right, let's see how this company is doing. I haven't invested in them yet, but when I log in or open this app, I can see quickly right now what's the price, how's it been doing, do they have any recent news, without having to go search and Google everything all over again. And then lastly, devote 5 to 10 minutes a day just to read some of the top articles on CNBC or Yahoo Finance, and substitute the time that you're using to scroll social media. Because you can scroll through a news article the same way you scroll through Facebook feeds and Instagram or whatever you're on regularly. And take 5 or 10 of those minutes and say, all right, what's going on in the financial world? Even though I might not 100% understand some of the big words and terminology, I just need to have a general awareness and getting used to hearing some of these terms and recognizing some of these terms, because I am making the transition or recently made the transition to become an investor. And if I'm going to build wealth, I need to know what's going on in the financial world. And I need to be more comfortable with reading the news that's going on in that particular arena. Shanitra said that. Oh, yeah, substitute social media scrolling, right? But outside of these, Ash, you got any extra takeaways you can think of from just tonight, or adding on to any of these on the screen?
I would just say that once you narrow down your top 10, 15, 20, get narrowed down to like your top 5, because it's so much easier to invest in your core 5. But get down to 5 after you do your research, because just because everyone is using it or you're using it doesn't mean that it's always a great company. And your research will allow you to do that. So get good at Xing companies off your list as a result of the research you've done.
That's a good one. Yeah, because once you get that 20, you want to start to narrow it down so that you can focus on something.